Is it worth it to use dollar cost averaging? This is not financial advice because currently I am not a financial advisor. I still have 3 years of experience under my belt and 7 years of learning, so keep listening. Imagine you had a crystal ball that told you exactly when Bitcoin's price was going to turn on the daily chart. If that were the case, you would buy here, sell here, buy back here, sell here, then buy back again here. You get my point. As you can see here, trying to time the market doesn't even work for most of the professionals. But what is dollar cost averaging that is supposed to be these professionals? It's a very simple concept where you allocate a certain amount periodically, like 20% of your monthly salary, into the same asset, building up a big position over time, taking the weight of stressing over news off your shoulders. This only works when time is on your side, so whatever asset class you are buying, it is a good idea to pick something that is proven. For US stocks, most investors would pick the S&P 500 ETF. This is a package of the 500 most successful companies in the biggest economy in the world. It is true that history does not necessarily predict future performance, but it is hard to see the US to stop thriving for more than a decade. For crypto, most people would choose Bitcoin or Ethereum, depending on their preference of the two. Bitcoin is a comparatively conservative asset with proven low inflation rates and the biggest crypto market share. Ethereum is the oldest and most widely known platform for smart contracts, so if one thinks we are heading towards Web 3.0, they can also choose this. Your goal as an investor or trader is of course to buy low and sell high. There are only two cases where timing the market tends to do that better than choosing to DCA, which is either dividend investing or in market environments such as right around the COVID scare in 2020 or the global recession we are currently going through. These opportunities don't come around often, and it's especially good to see this coupled with the crypto bear market. Whenever articles reference a contrast between the buy the dip strategy and the DCA, they tend to only look at one market, which is usually the US stock market. I would argue that if you study more than one market, for example in my case, a bit of the Chinese stock market together with the US and crypto, you will be able to find opportunities more frequently because these markets have limited correlation. More active investors or traders can actually be happy that crypto has this 4-year cycle engraved into it because this regularly creates opportunities for retail investors like you and me. So, my conclusion. Passive investors are better off DCAing into the S&P 500 and not looking back until their retirement. Anyone who decides to become an active investor needs to know more than one market, which is a hell of an effort. So if you'd like me to do some of your research, subscribe.